All right, so we have a fourplex here, and we're gonna analyze it. 2590 East 20th Street, Chico, California. One of the nicest fourplexes in a really nice area, nice neighborhood, good views of this open area off Bruce Street. Okay, so you have some information here, so you can see the gross income, and then we have the expenses, and these are broken down in their annual expenses right here in this area. A little bit of information, not all the expenses, but there's some of the expenses. You can see no professional management, no landscaping included, things like that. Taxes aren't included here, so we have to do that math ourselves. Unit mix, we can see it's a bunch of 2-bedroom, 1.5 baths. It actually has it, up here. 2-bedroom, 1.5 baths. It's in the description. And then it has a 1-bedroom, 1 bath. Okay. So, and these are a little different. There's some other ones that look exactly the same on the outside that have 3 bedrooms and other things like that. So, anyways, let's look at it. Let's go over here. I just want to show you how I got these numbers. This is how you analyze property. So when you look at the rents, I just took the rents that were over here and plugged them right in here. Now the first unit, unit number 1, is rented by the owner. So he says you can get $1,900 a month. I think it's a little far-fetched. I think in the future you can get $1,900 a month. I think right now in this current market, $1,550 is about pretty good, And then if we go over here to scenario B, so this is what I put for scenario A. If we go over to scenario B, I just raised everyone's rents $100 and then say we can get $1,650 for that vacant unit. Okay, so we have vacancy credit and loss, 3% gives you about 10 days a year that all these units are not going to be rented. So that might be conservative. So over here I say 2%, and that's about 7 days a year. All these units are going to go vacant. That's for turnovers and things like that. Property management, I put 8%, and then for the aggressive, kind of optimistic scenario, I put you can get 7%. Okay, and all depends on the management company you use. You can even self-manage and save yourself all that, but then you're not having a passive income. You're self-employed basically because you have a job to manage this. All right, repairs and maintenance, real estate taxes. This is based off the scenarios where you purchase it. And that's down the spreadsheet just a little bit. Replacement reserve, these are things like hot water heaters or roofs or other things like that. I'm just saying, hey, look, save yourself $80 a month every single month until some major capital expense comes up. Exterior painting, things like that. So usually, no one puts that in there, but you always want to have that. That's a real expense. Water and sewer, garbage, landscaping. There's some grass here, so I put $100 and, 110 or 100, depending on the landscaper you hire. Okay, so GSI, gross scheduled income right here, expenses, and you got a NOI, net operating income, $36,000, and so in this scenario, it's going to be $43,000 a year. Now, this is the target cap rate. If you want to get a 5%, it's pretty good for this market right now. I've seen a lot of things. 4.5 is general. 4, there's some 3, kind of a high 3% cap rates. That's just the market that we're in right now. So if we got it for a 5%, obviously this is off by about $170,000. You'd have to get at that to get that 5%. That's not going to happen. So if you could get it maybe at 862, possibly. There's a lot of liquidity in the market right now chasing these assets, and so I don't know if you'll be able to get that or not. It all depends on who's willing to spend the money. Purchase price, so they're asking $900, and this is, I'm just saying, if we got it at $865, you would have a cap rate of about 5%. That would be the top of the market. That would be a good deal in this market right now. And this would be 4%, and that would be kind of an average deal, okay deal, kind of top end, and that's kind of what they're at the top end of the market. That's where they priced it for what you're getting. Down payment, just put 25%. Here's all your loan information. I highly recommend getting debt on this, not doing cash. With inflation, we're in a 5% inflation rate, so the rents are going to go up, a lot's going to go up, but your interest rate's not, and it's all going to stay the same right here. And so if you could buy it below, get the interest rate below the inflation rate, then you're doing really, really good. So 3.5, 3.75. I had a 15-year a guy with a 15-year note. He just got 1.875. That was like a week ago. So you have to talk to your lender and see what you can get there. Anyways, if you brought this all down and paid all your expenses and your mortgage every month, and your reserve, you would have a negative cash flow of $88. So that would not make sense. So what you'd want to do is raise someone's rent at least $100. Then at that point, you know, you'd be positive. Also take into consideration that 3% of this is vacancy. So if you didn't have any vacancies, you'd save all that money there. It's about 100. I think the vacancy was $150 a month. So there's a lot of invisible expenses here that you wouldn't see. But as it is now, that's the number that you get. Now, if you had this scenario and you operated it well, you raised the rents and you got the good deal on the price and you got 3.5% interest rate, you'd be cash flowing day one $680 every month. And your loan would get paid down $12,000 a year every year. Actually, this number would continue to go up as the amortization schedule shifts, you know, and you'd be able to take a loss on your taxes with depreciation and everything else like that. Cash on cash return in this scenario is going to be 3.48%, and in the conservative scenario, it's going to be negative 0.4%. So that's how you analyze the property. These are the numbers that you get, and that is all. Thanks for watching.